Our next guest is Paul Kedrosky, a Bloomberg contributing editor and author of the blog Infectious Greed. He says it's high time to be looking through the other end of the telescope. That means calculating how much a company can make by selling its assets if it goes belly up. So optimistic of you, Paul. Paul joins us right now from San Diego. So first of all, Paul, I have to ask your opinion on the volatility that we've been seeing in the markets the last week. You heard Liz Beyer speaking earlier. Pretty optimistic viewpoint from her. Do you think this means it's going to get worse before it's going to get better?
Yeah, of course. And and the idea that it doesn't have any impact on the IPO market is nutty. I mean, of course, it has a monstrous impact on the IPO market because it's the reason why we're seeing more IPOs now than we were 2 years ago. There were quality companies then, too, but they didn't get to go out en masse because investors didn't want to buy more high beta companies, highly volatile companies. There's nothing worse than taking a high beta company public during a period when high beta stocks are getting shellacked, which is what happened in the last 7 days. So it's going to be a lot tougher over the next couple of months.
So by worse, does that mean the bubble is going to deflate?
Yeah, absolutely. I mean, it's going to be much harder. The prices are going to be much tighter. We saw that. I mean, Carbonite got out this week, but it got out at a much lower premium. It sold at the low end of the pricing range and then traded up slightly, but really hasn't moved much. And I think that's about the best you're going to see from new issues over the next little while, with the possible exception of Zynga, which is and has always been an anomaly in the IPO market.
Now, you're adjusting your investment strategies in this environment. You've got this theory called the Apple Death Star. Explain that to us.
Sure. So, I mean, one of the things that's really interesting about what's going on right now is that, and we talk about it all the time, we've talked about it on this show, that a lot of the companies that are coming public right now have revenues. And we act like this is incredibly exciting, like we're kids with new toys. Oh, look, they have revenues. This is great. But we never sort of ask the question of where the heck did the revenues come from? They don't come from, other planets, or, they're not coming from the Fed. We're not printing, or at least not printing all of their revenues. So they're coming from somewhere. So the question that people need to ask in the ecosystem around these young companies is where are their revenues coming from? And in the case of Apple, which is one of my Death Star trade, I call it, is you can ask yourself, where are those revenues coming from? Well, they're coming from companies like Nokia. They're coming from Motorola Mobility, Books A Million, RIM. And what's really interesting is, say, for example, this year, in the 6 months leading up to the crash, in the last week or so, you would have done better being short all the companies that Apple was stealing revenue from, that list of companies I just described, than being long Apple. And that's one of the consequences of having startups that suddenly have revenues, is those revenues come from somewhere and are often much more destructive to the companies where the revenues are being stolen than they are beneficial to the companies that are growing. And investors miss this all the time. And I think it's a very handy way in a volatile market of rethinking your investment strategy.
So what does it mean for startups? We know companies are now cheaper to start than ever before. There seem to be more technology startups out there than ever before. What does it mean for all of these companies?
Yeah, so, and it's the stuff that used to cost $4 or $5 million to create back in the glory days of the last bubble, maybe cost $500,000 or even $50,000 to create now, which we all think is great because it drives more entrepreneurship, and entrepreneurship is good for the economy, yada, yada, yada. But the flip side is as these companies go bust, and many of them will, well, actually most of them will, because that's the nature of capitalism, the question becomes, what's the recoverable value? What's the end value, the terminal value of these companies? What can I sell their assets for? Because that gives me a bottom as I think about their valuation. And the reality is that because so much of their assets are in the cloud, they don't have computers, they don't even have servers, and a lot of them aren't even writing software that runs in-house. It's all sitting out in the cloud. The terminal value of many of these companies is much lower than they once were. So the new calculus you have to do to find a terminal value for many of these startups in the event that they fail is rethinking all of your ideas about where the value is. Now, it's better for worse, it's in patents and IP, which I hate. It's in brand, which is better. And it's in customer relationships. Subscription revenues are better than one-off revenues. And then finally, it's in actual hard assets. We've completely flipped the pyramid upside down in terms of calculating values. And the result, the recoverable values from many of these startups will be much lower than the recoverable value from the startups that failed in the last bubble. And that's a really big deal.
So are you saying that the stakes for startups are even higher today than they were 10 years ago if things don't work out?
That's exactly right. I mean, the investors are going to see far less recoverables from failed startups in the current cycle than they saw in the last cycle, and actually have seen in any previous technology cycle, for the exact same reason that we've been applauding the current cycle, which is that the cost of company creation has fallen through the floor as the cost of creating all of the things on top of which the companies run has collapsed. And that has a consequence. And that consequence is the hard assets you have available, if you fail, drop accordingly, which means the floor on the value for these companies is lower than anything we've ever seen. And that's something that no one's talking about, but really needs to be factored into your thinking.
So how do you think the market turmoil that we're seeing now is going to trickle down and impact venture capital and potentially impact the startup landscape and all of the enthusiasm that we're currently seeing there? Is the money going to dry up?
Oh, it's already happening. So it's not quite as bad as we saw in 2008, but there's already a feeling, especially among seed investors who are much more tied to their own net worth and what's happening in equity markets, who are already pulling back. I'm seeing it happen now. I've actually had, in the last 4 or 5 days, had some very, very sad pitches that made me kind of depressed from people who were saying, all of a sudden, no one's returning my phone calls. What am I going to do? The angels aren't there for me anymore. And what's going to happen at the venture end is venture investors will say, aha, I'm not competing against angels anymore. So to the extent that I'm investing, I'm going to drive valuations down. So startups kind of get whammied at both ends. There's fewer angels available and valuations are coming down, and it's happened that fast. We've already seen it over the last 4 or 5 days.
Are there any specific areas where valuations are dropping or money is drying up?
Consumer-facing stuff, anything consumer-facing right now, which had already been weakening somewhat in the month leading up to this week's volatility, has gotten much worse. So you're seeing a host of startups that are all nominally facing consumers and driven by ad revenues and related subscriptions that are all falling off the map. And that had naturally begun and has now just gone sort of right over the cliff. So now the question you have to ask as you're talking to early-stage companies that are selling into consumers as opposed to taking social technologies into enterprise, into large companies is, who's going to fund that? Because the answer, generally speaking, is nobody.
Now, you and Vivek Wadhwa, entrepreneur and academic blogger as well, had a very spirited debate last time you were on this show. He has said that he thinks the golden age of startups is over. Would you agree with that?
I hate agreeing with anything Vivek says, so I'll say no. Just on principle, I'll say no. No, I mean, the drivers are still the same, right? More awareness of the entrepreneurial opportunity than ever, and the cost of company creation has fallen through the floor. So it's pretty hard to argue in an economic sense that the golden age is over. It's probably the golden age of startups is just beginning. I don't know how you get to deciding that it's over whenever the cost of company creation has never been lower than it's been now. You might say the age of creating quick flip consumer-oriented startups for $25,000 is over, and it probably is, and I say good riddance.
All right, Paul Kedrosky, I think the reverse is true as well. Anything you say, Vivek, we'll try to debate that as well. Thanks again for joining us here on Bloomberg West.